Good day, my viewers, and welcome back to this channel, Accounts and Business with Abiola. We continue with the concept of depreciation schedule. Today we'll be looking at the second method of depreciation, the reducing balance method. The proponents argue that some assets actually will serve the business more in the early years and be more efficient in the early years than in the later years of its existence with the business. Hence, the depreciation that will be charged on these assets will be higher, and for subsequent years will be reducing. That's why we call it reducing balance method. So sometimes a business will have a rate of percentage that it uses to charge as depreciation for the non-current assets. However, if a business does not have a fixed rate, the formula to use to get the rate to use is one. So it's calculated as 1 minus the nth root of scrap value over cost. If you are using a scientific calculator, it can be done straight away. But if you are not using scientific calculator, first find the value of scrap over cost, then nth root of that. For instance, in the example that was used in the straight line method of depreciation, cost was 10,000. Scrap value was 1,000 in that example, $1,000, $10,000, and expected number of years. Wow, years 5. So in this case, 1,000 over 10,000 will be here. The answer you get, this nth root, so fifth root of 0.1 or 0.1 raised to power 1 over 5. The manual calculator somehow will do that for us. So that answer, we deduct it from 1. 1 minus this will give us the answer in decimal. So we multiply it by percent, by 100 to give us the rate of percentage to be used. Now, if a business is using, let's say, 10% of depreciation, if it's business policy to use 10% depreciation on its assets, and it is using reducing balance method, please do not forget that any method of depreciation a business is using must be consistently used, must not be changed in the following year of the asset or third year of the asset. This concept of consistency is well explained in the accounting concept and convention released in this channel, by this channel. So please search for it and watch it to get better knowledge of accounting concepts and conventions and principles. So consistency actually says method that you have used or that you have chosen to be using should be consistently used, should not be changed maybe the second or third year without any valid or without any important reason. Should not be changed. So if 10% is being used by the business for the rate of depreciation, I want to use reducing balance method. So this is how the schedule will be prepared. So in the question that we use 10%, rate 10%. So if I are using this question to prepare the depreciation schedule for these assets using reducing balance method, this is how we calculate the depreciation. For year 1, the new value or the opening value or the purchase cost is $10,000. Then the depreciation, we are using 10%, assumed 10%. 10% of 10,000 is 1,000. That means the closing value or the net book value is 9,000 at the end of year 1. The following year, it will be 10%, this rate, of the beginning value. And what's the beginning value or the opening value at the beginning of year 2? That is 9,000. This 9,000. So 10% of 9,000 is 900. So 900 minus 9,000 minus 900 is 8,100. For year 3, the beginning value is this 8,000. That means the asset has reduced to this value at the beginning of year 3, 8,100. So 10% of 8,100 is 810. So 8,100 minus 810 is 7,290. 8,100 minus 810 is 7,290. Then in year 4, the value at the beginning of year 4, that means the value that the asset has reduced to after 3 years or at the beginning of year 4 is 7,290. So the 10% is the depreciation of this, 10% of this, which is 729. So 7290 minus 729 is 6561. 6561. That is the value at the end of year 4, which is the same as the value at the beginning of year 5. 6561. So it will be 10% of 6561 that will give us the depreciation in year 5, which is 656.1. So 6561 minus 656.1. 656 gives us 5904.9. So this is the value at the end of year 5. So when we now prepare our provision for depreciation account as was prepared in straight line method, this will be the depreciation in year 1, depreciation in year 2, depreciation in year 3, depreciation in year 4, and depreciation in year 5 respectively. And when we get to income statement extract, this will be the values that will be charged as expenses for provision for depreciation. And when we get the statement of financial position, the extract of it under assets, machinery is asset, and provision for the cost is 10,000, and aggregate depreciation for each year. Year 1 would be 1,000. Year 2 would be addition of 1,900. Year 3 accumulated depreciation would be 1,900 and added to 810. And in year 4, addition of all this, and in year 5, addition of all this depreciation will be your aggregate depreciation for the extract of balance sheet. That is how to prepare it using reducing balance method of depreciation. Thank you. At the beginning, if